Imagine a fire in your apartment, not a huge one, a kitchen fire, contained, put out in minutes, but the smoke got everywhere. Your furniture, your clothes, your laptop, the mattress you sleep on, all of it ruined. A few weeks later, the building is repaired. New drywall, new paint, good as new. Your landlord's insurance paid for every bit of it. The walls are whole again. And you? You're standing in a freshly painted, completely empty apartment. Because your landlord's insurance rebuilt the landlord's building. It paid you nothing. Not for the couch, not for the laptop, not for a single shirt. Most renters don't learn that boundary until the worst possible moment. Today, we're gonna learn it before the fire. Hey, welcome back to Policy Unpacked. If you're new here, this is where we read the fine print so you don't have to, in plain English, with no sales pitch. Glad you're here. Today, it's renter's insurance. And the one thing your landlord's policy will never do for you. Quick ground rules first, then we dig in. Quick ground rules. This is general education about how renter's insurance works in the United States, not advice about your specific situation. Policies, coverage limits, sublimits, and prices vary by state, by insurer, and by the exact wording of your policy. Every person and number here is a simplified, illustrative example. When it's time to act, the document that matters is your own policy, not this video. The core idea is simpler than the industry makes it sound. When you rent, two very different things share the same address. There's the building, the walls, the roof, the floors, the plumbing. That belongs to your landlord. And there's everything inside it that you carry through the door. That belongs to you. Two owners, two completely separate risks. And almost everyone makes the same mistake. They assume one insurance policy covers both. It does not. Your landlord insures the landlord's half. Nobody insures your half, unless you do, and your half is worth more than you think. Add it up honestly. The bed, the couch, the TV, the laptop, the phone, the clothes, the kitchen, the little things you've collected over years. For a typical renter, that's easily tens of thousands of dollars of stuff. Now ask the uncomfortable question. If all of it disappeared tonight, fire, theft, a burst pipe, could you replace it out of your own pocket all at once? For most people, the honest answer is no. That gap between what you own and what you could suddenly afford to replace is exactly the risk renter's insurance is built for. And there's a second risk hiding in that apartment, one that has nothing to do with your stuff. It's the risk that YOU cause harm. A guest gets hurt. A fire you started spreads to a neighbor. Suddenly, you don't just have a loss, you have a legal responsibility to someone else, and those can be far larger than everything you own combined. We'll come back to that, because it's the part almost nobody thinks about, and the part that can do the most damage. So keep both risks in mind as we go. Risk 1, something happens to your things. Risk 2, something you do affects someone else. One insurance policy is built to handle both. And it is almost certainly not the policy your landlord bought. Renter's insurance has a technical name, an HO-4 policy, and underneath the jargon, it does exactly 3 things. Job 1, your belongings, officially personal property. If your things are damaged or stolen by a covered event, the policy helps pay to repair or replace them. Furniture, electronics, clothing, the contents of your life. Job 2, your liability. This is the one people forget, and it may be the most important. If you accidentally hurt someone or damage someone else's property, this covers the costs, including your legal defense. We'll see exactly how powerful that is in a moment. Job 3, somewhere to live. Officially, loss of use. If your apartment becomes unlivable after a covered event, like that fire, the policy helps pay for a hotel and meals while it's repaired. So a disaster doesn't also make you homeless. 3 jobs. Your stuff, your liability, a roof, while yours is fixed. Now the most important detail in the whole policy, the one that decides whether a claim leaves you whole or leaves you short. How they calculate what your stuff is worth. There are 2 ways, and the difference is enormous. The first is called actual cash value. The second is replacement cost value. Same policy, same fire, wildly different checks. Actual cash value pays what your item is worth today after wear and tear. Replacement cost value pays what it costs to buy a new one. Let me show you the gap with a single television. Say you bought a TV 3 years ago for $2,000. Today, used, it's worth maybe $500. Under actual cash value, the policy pays you $500. The depreciated value, enough for a much smaller TV. Under replacement cost value, the policy pays what a new equivalent costs today. The full $2,000. Same fire, same TV, 4 times the payout. Now multiply that gap across every single thing you own. One word, depreciation, quietly decides how much you actually get back. And the gap matters because of how people actually rebuild. When you lose everything at once, you don't replace it with 3-year-old used goods. You walk into a store and buy new. New mattress, new laptop, new everything at today's prices. Actual cash value hands you the depreciated total and leaves you to cover the difference. Replacement cost meets you at the register. Replacement cost coverage costs a little more each month. Actual cash value is cheaper up front and much more painful at claim time. Neither is a trap. But you should know which one you have, because on the worst day, it's the difference between rebuilding your life and settling for a fraction of it. And this is the theme of the whole episode, really. Renter's insurance is rarely expensive. The costly mistakes are almost never about price. They're about assumptions. Assuming you're covered when you're not. Assuming the payout matches the new price when it's actually the used one. The policy is cheap. The wrong assumption is what gets expensive. Let's run a normal, everyday claim through the policy. Meet a renter. We'll call her Maya. Fictional, like everyone here. Maya comes home to a broken window and an empty desk. Someone took her laptop, her camera, and a bit of jewelry. It's every renter's small nightmare. Her landlord's insurance does nothing. A break-in that steals a tenant's belongings isn't the landlord's problem. The building wasn't harmed, and the building is all the landlord's policy covers. Without her own HO-4, Maya absorbs this loss entirely herself. But Maya has renter's insurance, so her personal property coverage steps in. The laptop and camera are covered up to her limits. The jewelry, though, teaches the next lesson. Because most renters' policies cap certain categories. Jewelry, for instance, often has a special sublimit. The policy might only pay a set amount for it no matter how much was taken. Same for cash, for electronics, for a few high-value items. It's not the insurer being sneaky. It's printed right there in the policy. But it's how a renter who thought she was fully covered discovers a gap at claim time. If you own something genuinely valuable, that sublimit is the number to check, and often to raise. So scenario A ends reasonably well. Maya's core losses are covered, minus her deductible. The amount she pays before coverage kicks in, the system worked. But it worked because she had her own policy. The landlords did nothing at all. That's the boundary in a single break-in. Now the scenario people never planned for, because so far, Maya has been the victim. What happens when Maya is the cause? 2 versions. Version 1. A friend visits, slips on a wet floor in Maya's apartment, and breaks a wrist. Ambulance, emergency room, surgery. The medical bills climb into the tens of thousands. And they landed there because of an accident in Maya's home. This is where liability coverage, Job 2, becomes the most valuable part of the whole policy. It can pay those medical costs, and if the friend sues, it can pay Maya's legal defense too. Without it, that bill lands squarely on Maya. Version 2 is bigger. Maya leaves something on the stove. A fire starts. It's put out, but not before it spreads, damaging not just her apartment but the units next door. Now Maya may be responsible for other people's damaged homes and belongings. That liability could run to enormous numbers. Here's the part that should get your attention. Liability coverage usually starts at around $100,000, but you can often raise it to $300,000 for only a couple of dollars more a month. A couple of dollars against a fire that spreads or an injury that sues. The thing most likely to truly bankrupt a renter isn't losing their own stuff. It's being held responsible for someone else's catastrophe. And the coverage for that is often the cheapest line on the entire policy to strengthen. A fire extinguisher that costs less than lunch. You hope to never use it, And on the one day you do, it is the best money you ever spent. And liability follows you further than you'd expect. In many policies, it isn't just about accidents inside your apartment. It can extend to things you're responsible for elsewhere within the policy's terms. The point isn't to memorize every scenario. The point is to understand what this coverage really is. A shield around your responsibility to other people wherever that responsibility follows you. Scenario: A protected Maya's things. Scenario: B protected Maya's entire financial future. And the landlord's policy. We're saying one more time. Covered neither. It never touches the tenant's liability at all. Put the two scenarios side by side, and you see the shape of the whole product. One side catches what happens, TOU. The other catches what happens because of you. A landlord's policy, by design, does neither for the tenant, because you are not what it was built to protect. You were never in that contract at all. No policy covers everything, and pretending otherwise is how people get hurt. So let's be honest about the walls of this one. Renter's insurance covers a specific list of causes: fire, theft, vandalism, certain kinds of water damage, and more. But it is a list. If your loss isn't on it, you're not covered. This is named peril coverage. It protects against named dangers, not all dangers. And two of the biggest threats in America are not on that list: flood and earthquake. Read that again because it surprises almost everyone. The two natural disasters that cause some of the most devastating losses to American renters every year are excluded from a standard renter's policy. Flood needs its own separate coverage. So does earthquake. If you live where either is a real risk, a standard HO-4 alone leaves you exposed. There are other gaps too: wear and tear, pests, gradual damage from neglect. Insurance covers sudden, accidental events. It does not cover slow decay or things you are supposed to maintain. That's not a loophole. It's the whole logic of insurance. It's there for the accident, not the inevitable. And remember those sublimits from Scenario A. If you own something valuable, good jewelry, high-end gear, a collection, the standard limits may not stretch to cover it. The fix is usually a small add-on that raises the limit for that specific item. But you have to ask for it before the loss, not after. Now here's the part that catches people even when they did everything right. They bought the policy, they read the limits, and then they lose everything, and the insurer asks a question they cannot answer. What did you own? Think about that for a second. Your apartment burned, your things are gone, and now you have to prove, item by item, that they existed. The laptop, the winter coats, the kitchen you spent 4 years filling. Insurers do not simply take your word for it on a total loss. They ask for an inventory, and a renter who has no inventory gets paid on what the adjuster can reasonably estimate, which is almost never what the renter believes they lost. This is the cheapest 10 minutes in this entire episode. Walk through your apartment with your phone, open every drawer, every closet, and film it. Say what things are out loud as you go, then email the video to yourself so it lives somewhere that is not in the apartment. Receipts for anything expensive, serial numbers for electronics. That is the whole exercise. It costs nothing, and it is the difference between a claim you argue and a claim you simply file. And when something does happen, the order matters. Police report first if it was theft because most policies require 1. Then tell the insurer. Policies set a deadline for that, and it is shorter than people expect. Then document the damage before you clean anything up. That last one costs people money constantly. You come home to a flooded apartment and your instinct is to start mopping. Photograph it first. Once it's cleaned, the evidence of how bad it was is gone. So let's talk about what all of this actually costs, because I have been avoiding a number, and you have probably noticed. According to the Insurance Information Institute, the average renter's policy in the United States runs about $171 a year. That's roughly $14 a month. For that, a typical policy carries around $20,000 of coverage on your belongings and $100,000 of liability. Run the comparison, honestly. Earlier you added up your things. Whatever number you landed on, the coverage costs you a fraction of 1% of it every year. And here is the single best value line item in the whole document. Raising your liability from $100,000 to $300,000 typically costs about $2 to $4 more a month. Read that again. $2 to $4 for triple the protection on the exact risk that can follow you for years. The guest who falls, the fire that spreads, the judgment that outlives the policy. Almost nobody takes it because almost nobody knows it's that cheap. Which brings up the number that explains why this episode exists at all. Depending on the survey, somewhere between 40 and 45% of American renters have no renter's insurance whatsoever. Among renters aged 18 to 34, it's worse. Roughly 1 in 4 carries a policy. 3 in 4 are covering everything they own out of their own pocket, whether they know it or not. And when you ask renters why they skipped it, the answer is almost always the same one sentence. That the landlord already has them covered. So here's how to actually use all this. You don't need to become an insurance expert. You need to read 6 lines on your own policy. Or, if you don't have one yet, 6 questions to ask before you buy. Line 1. Personal property limit. How much will it pay for your stuff? And is that number anywhere close to what your stuff is actually worth? Line 2. Actual cash value, or replacement cost. This one word decides whether a claim rebuilds your life or hands you the depreciated scraps of it. Line 3. Liability limit. Where does it start? And could you raise it to $300,000 for pocket change? For most people, the answer is yes, and the answer should be yes. Line 4. Loss of use. Will it cover a hotel and meals if your place becomes unlivable? And for how much? Line 5. Exclusions and sublimits. What's not covered? Flood, earthquake, and what's capped, like jewelry or electronics. These are the gaps that ambush people at claim time. Line 6. The deductible. What do you pay out of pocket before coverage begins? A lower deductible means a higher premium, and vice versa. Know your number. 6 lines, 10 minutes. That's the entire difference between thinking you're covered and knowing you are. And it costs nothing but the reading. So let's answer the question we opened with. Your landlord has insurance. Are you covered? No, you never were. Their policy was never about you. Keep one mental model. Your landlord's insurance draws a line around the building. Renter's insurance draws a line around you. Your belongings, your responsibility to others, and a place to sleep while things are fixed. 2 lines, 2 owners, and only one of them is looking out for your half. Nearly half of American renters are betting their whole apartment on a sentence that was never true. The landlord's policy covers the walls. You cover everything that makes those walls a home. Next time on Policy Unpacked, we cross the boundary in the other direction. What changes when you stop renting the walls and start owning them? Home insurance is where the coverage gets layered and where most people misread what they're actually buying. Subscribe and we'll unpack it next. This is Policy Unpacked, how insurance actually works. No sales pitch.